In less than 48 hours, the currency pair that anchors global carry trades and corporate hedging didn't just drift, it snapped. 7%, a move big enough to force desks to reprice risk across portfolios that normally move in slow motion. 80 an ounce on January 29th, and then fell nearly 13% in just 2 sessions. Not months, not weeks, in 2 trading days. For years, the comfortable story was that these markets could be managed, that the yen would weaken in a controlled way, that bond yields would climb in an orderly fashion, that gold would act like a long-term ballast, not a lightning bolt. They said the pipes were thick enough, they said the plumbing was modern. And then the data did what it always does when a system is stressed. It revealed the weak joints. Because here's what makes this moment different. When the yen moves like that, it's not usually retail emotion. It's not a tweet. It's not a chart pattern. It's funding stress, policy signaling, or forced positioning, often all 3. That's hedging programs adjusting in size and speed and in urgency. Institutions already see these pressure points. They're paid to see them. They measure them. They hedge them. Most people only notice after it becomes a headline, after it becomes a story, after it becomes a narrative. But what I'm about to lay out isn't a prediction. It's a pattern. And once you see the pattern, the last 48 hours stop looking like chaos and start looking like a message. Welcome to Macro Signal, the channel where we decode what matters before it becomes a talking point. We don't chase excitement, we track stress. If you like the feeling of listening to that wise elder who's calm while everyone else is loud, you're in the right place. And if you're watching from Tokyo, London, New York, Singapore, Kathmandu, or anywhere in between, drop your city in the comments. Because markets may be global, but the consequences are always local. Now let's reconstruct what actually happened, because the order matters. Late in the week of January 24th, USDJPY broke lower fast. The move was sharp enough that traders immediately started asking the uncomfortable question, was this intervention, or was this the market front-running intervention? Reports circulated that U.S. officials had conducted rate checks, the kind of behind-the-scenes inquiry that often precedes coordinated messaging or action in FX. Whether or not direct intervention followed, the signal alone can shift positioning, because in FX, the cost of being wrong is not a gentle drift, it's a sudden gap. At the same time, Japan's bond market was sending its own flare, 26%, the highest level seen since 1999. That sounds like a small number if you live in a world of 4% and 5% yields, but in Japan, that's tectonic. Japan's economy and financial system were built on the assumption that rates stay low, volatility stays compressed, and duration is a sleeping giant. When that giant wakes up, even slightly, everything connected to it begins to wobble. Then gold did something that, psychologically, is even more destabilizing than a steady rise. It delivered a peak and a reversal so violent it forced people to ask whether the hedge itself had become a source of stress. 80 on January 29th, then almost 13% down within 2 sessions. That's the behavior of a market where positioning, liquidity, and hedging demand are colliding at speed. And this is the central mystery. Why would the classic safety valve, gold, become so volatile at the Einste? Same time the world's most important funding pair, USD-JPY, breaks pattern? The real answer is dislocation. 2 parts of the system are moving, but not in harmony. And when markets stop moving in harmony, the gap between them becomes the trade everyone is forced to manage. To see why, you have to zoom out and recognize the hidden playbook, because this isn't the first time the yen has been the fuse. In 1998, during the Asian financial crisis and the long-term capital management shock, the yen strengthened violently. Funding trades that relied on cheap yen financing were squeezed as risk came off. The result wasn't a gentle adjustment, it was a scramble. Portfolios that were diversified discovered they were all leaning on the same funding assumption. In 2008, the story repeated with a different costume. As the global system seized, carry trades unwound. The yen strengthened as leveraged risk was forced to delever. That wasn't because Japan suddenly became the growth engine of the world. It was because the yen was the funding source. And when leverage dies, funding currencies jump. The result was a cascade across equities, credit, commodities, and emerging markets. Then in 2022, the pattern inverted in an important way. The yen weakened dramatically as the US tightened and Japan held policy steady. That weakness built tension, because it wasn't just a chart. It was a pressure on import costs, on household purchasing power, on the perception of policy credibility. Intervention risk became a permanent background noise. Markets learned to trade the possibility of a sudden, sharp yen move even when the day-to-day drift pointed the other way. Now in 2026, the ingredients are back on the table. Policy uncertainty, bond yield instability, and positioning that assumes volatility will stay contained. 7% in a day, it's the market admitting that the risk of discontinuity has risen. When gold prints a record and then sells off nearly 13% in 2 sessions, it's the market admitting that hedging demand is arriving in bursts, not streams. So who is moving, and how can we tell? Let's start with the flows that are too large to fake. In January, global gold ETFs reportedly pulled in about $19 billion of inflows, pushing total assets under management to a record around $669 billion. That's not a fringe trade. That's institution-sized allocation, the kind that comes from committees, mandates, and risk systems that rebalance when volatility and correlation shift. Next, look at the physical side that quietly underpins the paper market. $467 trillion. Those numbers matter because they remind you that gold isn't infinite. The paper claims can expand faster than the physical pipeline can respond. And when hedging demand surges, the market has to decide whether it reprices the metal or reprices the risk of holding it. Then look at volatility itself, because it's the language risk managers speak. 3981 on February 6th. That level doesn't tell you direction. It tells you cost. It tells you how expensive it is to ensure exposure. When volatility stays elevated, hedging becomes a recurring expense, not a one-time adjustment. That changes behavior. That changes flows. That changes feedback loops. Now, layer in the dollar side, 8% in the reference session and hovering near the lowest level seen since early 2022. Again, not a forecast, a condition. A weaker dollar can support gold mechanically, but it can also amplify cross-currency stress if the move is tied to confidence and capital flow shifts rather than simple rate differentials. Here's where it gets interesting. These aren't isolated facts. They're pieces of a single mechanism. The yen is the funding pressure, Japanese yields are the constraint, gold is the hedge response, and the dollar is the backdrop that can either cushion or accelerate the whole move. When one piece jerks, the others adjust. When multiple pieces jerk at once, the system starts to show its seams. On one hand, USDJPY is moving like intervention risk is real, not theoretical. On the other hand, the assumption baked into many models is still that Japan remains the world's stable, low volatility anchor. 26% suggests a historic shift in the cost of money in Japan. On the other hand, many portfolios are still structured as if Japanese rates cannot meaningfully move, and gold adds a second dislocation. If gold were simply a steady hedge, it would rise into stress and hold. 80 and then drops nearly 13% in 2 sessions. It's telling you that hedging is happening under duress. Some participants are buying protection. Others are being forced to sell to meet margin, rebalance risk, or cover losses elsewhere. Gold becomes both the insurance policy and the ATM. That dual role creates violent short-term moves even when the long-term reason for holding gold remains intact. Let's put hard evidence on the table because narratives dissolve when numbers are specific. 7% one-day drop in USDJPY on January 24th, 2026. In a major currency pair, that is not background noise. 26%, the highest level since 1999, a quarter-century marker that tells you this isn't a weekly fluctuation. 80 on January 29th, and then down nearly 13% within 2 sessions. A magnitude of move that changes margin, options pricing, and hedging behavior immediately. 4. About $19 billion of gold ETF inflows in January, pushing AUM near $669 billion, signaling that the allocations are institutional in scale, $467 trillion, grounding the paper market in a finite physical reality. Now, how does this get executed in the real world? Not through dramatic speeches, but through dull mechanical constraints. Think of the financial system like a highway network. The yen is a major on-ramp for leverage. When it's cheap and stable, traffic flows smoothly. But if that on-ramp suddenly narrows, because the yen strengthens, because intervention risk rises, because funding costs jump, then everyone who relied on that route has to merge elsewhere at the same time. That is what creates jams. That is what creates accidents. And in markets, the accident is a forced unwind. In practice, the roadway change shows up as higher hedging costs, wider bid-ask spreads, and forced rebalancing. Currency hedges that were set and forgotten suddenly have to be adjusted. Japanese institutions that own foreign bonds have to decide whether to hedge more or less. Hedge funds that ran carry trades have to decide whether their stop levels were real. Corporate treasurers see their cost projections shift. None of those decisions are ideological, they're operational. Gold's role in this mechanism is often misunderstood. When volatility is low, gold can behave like a slow hedge. When volatility spikes, gold behaves like a balance sheet instrument. It gets used to raise cash, to post collateral, to offset losses. That's why you can see a record high and a sharp sell-off in the same week. The market is not changing its mind about gold's long-term purpose. It's managing liquidity. The timing is the tell. A month with $19 billion of ETF inflows suggests large allocators were building positions or reestablishing hedges. A record AUM near $669 billion means those positions were not small. Then a record price and a violent reversal means the same holders were suddenly dealing with volatility and risk limits. 3981 tells you the options market priced that instability. When gold volatility is expensive, it discourages casual speculation and encourages structured hedging, but it also makes the market more sensitive to forced flows when risk limits are breached. 26% creates a constraint that can't be negotiated away by narrative. Higher yields mean higher debt servicing costs over time, and Japan's debt dynamics are always part of the background. Even if policymakers smooth volatility, the market is signaling a regime shift. The cost of capital in Japan is no longer guaranteed to be near zero. That changes how global investors think about the yen as a funding currency. And that brings us back to USDJPY breaking pattern. 7% daily move tells you someone is either scared of intervention, forced out of a trade, or both. Rate checks and policy signals act like a lighthouse in fog. Ships don't have to crash into it for it to change their path. The mere possibility of action changes behavior. That's why intervention talk is powerful, even when actual intervention is rare. To understand why the hedging wakes up overnight, picture the institutions that sit between these markets. In Japan, the Ministry of Finance is the legal trigger for currency intervention, while the Bank of Japan steers liquidity in the bond market. In the United States, the Treasury and the New York Fed can coordinate FX messaging and operations. Around them are the primary dealers and global banks that actually make the two-way prices. When their risk models flip from routine to event, the market changes texture immediately. That's why a reported rate check matters. It sounds bureaucratic, but it's a signal that phones are ringing across dealing rooms. Dealers widen spreads, liquidity providers step back, options desks rehedge, corporate hedges get updated. Speculators who were comfortable leaning one way suddenly realize the other side of the boat might have a very large paddle. It's less about the check itself and more about the cascade it triggers. At the same time, the rise in JGB yields changes the math for Japan's giant holders of foreign assets, insurers, pension funds, banks. Many of their foreign bond portfolios are hedged back into yen using forwards and cross-currency swaps. When yen volatility rises, that hedge becomes more expensive and less predictable. A committee can respond by hedging more, hedging less, or cutting the underlying exposure. Each choice produces currency flow. What looks like a simple USD/JPY candle is often the visible edge of a much larger balance sheet decision. It's also collateral. It's a duration alternative. It's an asset that is not someone else's liability. That's why it shows up in both central bank reserves and institutional risk frameworks. But that same institutional use is exactly why gold can become volatile at the worst possible moment. When gold rises rapidly, it increases the notional exposure of anyone short volatility or using leverage under the assumption of stable ranges. As the price moves, margin requirements and risk limits kick in, and the response is mechanical, not emotional. That's how you get the psychological whiplash. Gold acts like insurance over the long run, but during a short-run liquidity squeeze, it can also become the asset people sell to raise cash. It's the insurance policy and the ATM. The system is simply trying to stay funded. There's another layer most people don't track: paper gold versus the physical pipeline. Futures, options, and ETFs can scale quickly. Physical supply, refining, transport, and vaulting scale slowly. 467 trillion. Reminds you there are real constraints under the paper. When hedging demand surges, the market either sources metal, shifts bars between vaults, or reprices the metal to ration demand. That tension is one reason volatility can persist even after the headline move is over. Now add the dollar backdrop. 8% in the referenced session, and near the lowest level seen since early 2022, changes global hedging behavior. Investors outside the US suddenly juggle two moving parts: the asset and the currency translation. Japanese investors juggle that too, but with the extra twist that the yen itself is being driven by domestic yield dynamics and intervention risk. In that environment, hedges get layered. Gold is one of the few hedges that can sit inside that layered structure without being tied to one country's balance sheet. The ETF numbers show the scale of this shift. About $19 billion of inflows in January and a reported AUM near $669 billion tells you the marginal buyer is not small. It's the kind of allocation that comes from mandates and rebalancing rules. Those rules can support prices for a long time, but they also make the market more sensitive to volatility events because the positions are large and the risk controls are strict. This is where implied volatility becomes the X-ray. 3981 means the market is charging a higher insurance premium for gold exposure. That changes what protection people can afford, and it changes dealer hedging flows. In calm markets, that flow is a trickle. In stressed markets, it becomes a force. And back on the currency side, the yen remains the pressure point because it is a funding mechanism. If the funding currency strengthens, leveraged positions become painful, forcing reductions that can push the currency further in the same direction. 7% daily move is how the loop announces itself. If you want to watch the next phase without guessing, watch the places where rules force action. Watch whether USDJPY keeps producing daily ranges, because that's where intervention risk and forced positioning live. Watch whether JGB yields keep pressing higher or snap lower abruptly, because abrupt reversals are where volatility is born. And watch whether gold stays expensive to insure, because that tells you hedging demand is still active and liquidity is still being tested. And that brings us to the divide. The people who understand this aren't necessarily smarter. They're simply looking at the same dashboard institutions look at. They're watching funding currencies, not just stock indexes. They're watching bond yields, not just central bank speeches. They're watching volatility, not just price. They're noticing when a hedge becomes volatile, because that's when the system is under strain. The wealth gap in markets is often an information gap. Institutions move first because they have mandates and models that force them to. Retail moves last because it waits for certainty, and certainty arrives only after the move has already happened. The data doesn't wait, the tape doesn't wait, and dislocations don't announce themselves politely. 7% daily shift in USDJPY, like a 13% two-session reversal in gold after a record high. This is macro signal, where we decode what matters before it becomes headlines. If this connected dots you hadn't lined up yet, you know what to do. Because the question isn't whether markets will keep throwing these signals. The question is whether you'll recognize them the next time the pattern breaks, before the crowd decides it was obvious.